We are now entering the final countdown. I want you to look at the date on your screen. It is Wednesday, December 31st, 2025. We are exactly 36 hours away from the moment the world changes. In 36 hours, the sun will rise on January 2nd. The holidays will be over. The champagne will be empty. The markets will wake up. And the China export ban will become active law. But I need you to understand something very clearly. We do not have to wait until Thursday to see the damage. The damage is already here. For the last 48 hours, we have been warning you about a bifurcation, a splitting of the market, a moment where the paper world and the physical world stop pretending they are the same thing. Well, today, that split became a fracture. And that fracture just became a chasm. Ladies and gentlemen, Asian guy here, known as John A.G., speaking to you from Financial Secrets. And as I speak to you right now, there's no longer a single piece of silver on this planet. The global market has shattered into three distinct realities. And if you're looking at the price on your banking app, or your brokerage screen, or your favorite financial news ticker, you are looking at the wrong reality. You are looking at a ghost. Let's break it down. Because today, silver officially stopped being a global commodity with one price. It is now a three-tier market, and each tier tells a different story. This is the price in Shanghai. The Shanghai Futures Exchange closed its final session of the year at an equivalent of $84.55 per ounce. This is not a speculative price. This is not a hedge fund price. This is the price being paid by the manufacturing capital of the world. This is the price being paid by companies that consume silver, not trade it. Solar manufacturers, battery giants, electronics producers, state-linked strategic buyers. They are desperate. They are front-running the ban. And they are paying whatever it takes to secure inventory before the doors lock in 36 hours. This is the real economy screaming. Now let's move west. The Middle East, specifically the UAE and Dubai physical silver souks. We have confirmed live transaction prices averaging $79.61 per ounce. This is not panic, but it is tight. This is the honest physical market. No leverage, no paper games, no algorithmic spoofing. This market is demanding a premium. It is telling us something very important. Even outside the China export ban zone, physical silver is trading nearly $8 above paper spot. That tells you the shortage is global, not local. And then we have the final tier. Tier 3, the zombie price. This is the COMEX paper spot price in New York, currently trading at $72.15. Now I want you to do the math with me. $84.55 in Shanghai, $72.15 in New York. That is a $12.40 spread, a 17.2% premium. Let me say this slowly. In a functioning global economy, a 17% spread on a fungible commodity like silver is physically impossible. Arbitrage traders exist to close that gap. Banks exist to close that gap. Hedge funds live to close that gap. If they could, they would buy every ounce in New York at $72, ship it to Shanghai, and sell it at $84, printing risk-free billions. But they aren't doing it. The spread isn't closing. It's widening. Yesterday it was $5. Today it's $12.40. Why? Because arbitrage is dead. The traders know they cannot move the metal. They know the January 2nd deadline is a hard wall. They know that if they buy silver in New York today, they cannot ship it, clear customs, and land it in China before the licenses go active. The bridge is burned. New York is now an island of paper trading, stranded in a sea of physical shortage. So when you see $72.15 on your screen, understand this. That number is a lie. It is the price of a paper promise that nobody wants. The real world is trading at $84.55. And the fact that the paper market is lagging by $12 tells you something historic. The COMEX has lost control. It is no longer the price setter. It is the price suppressor. And the physical market has decided to ignore it. But the price split is just the symptom. The disease is far worse. Because while price is broken, volume has gone vertical. We just received the delivery data for today's session, and it confirms our worst fears. Yesterday, China vacuumed metal. Today, New York experienced a run on the vault. The delivery volume didn't rise. It exploded. Yesterday, we mocked the COMEX delivery numbers. Out of billions of paper ounces traded, only 69 contracts stood for delivery. That's 345,000 ounces. A joke. A purely speculative casino. But today, the joke is over. Preliminary delivery notices for December 31st show 1,847 contracts standing for delivery. Let's do the math. 1,847 contracts, x 5,000 ounces from 235,000 ounces, 9.2 million ounces demanded in a single day. Compare that to yesterday, 345,000, 19,200,000. That is a 26x increase. This is not increased interest. This is a raid. Nearly 2,000 large entities looked at the calendar, saw January 2nd approaching, and smash the deliver button simultaneously. They are cashing out their chips before the casino locks the doors. Why? Because they know what happens in 36 hours. Once China shuts exports, the global supply chain freezes, and that $12 Shanghai premium becomes a black hole. So they are draining COMEX while the price is still suppressed. From their perspective, they're buying dollars for 85 cents. They're demanding metal at $72 that trades at $84 in the real world, but only if they can get it now. This delivery spike is the system trying to correct itself violently. This is the sound of paper shorts getting trampled. Now imagine being the bullion bank on the other side. You sold those contracts. You assumed they would roll. They always roll. Until today. Now you owe 9.2 million ounces. Where do you get it? Shanghai? $84. Dubai? $79. But you sold at $72. You're buying high, delivering low, burning cash instantly. So you run to the Fed. And that explains everything. Yesterday we saw a $3 billion emergency repo injection. Today, another $2.8 billion. That's $5.8 billion in 48 hours. On New Year's Eve, quiet season, this is not normal. That's enough cash to buy 80 million ounces of silver. And the banks burned through it just to stay solvent. JP Morgan reportedly increased commodity loss provisions by $400 million overnight. Citibank is delaying physical settlements. Bank of America is extending delivery timelines to 2 weeks. Administrative delays. Banker language for, we don't have the metal. This is a bank run, but instead of $20 bills, they're 1,000-ounce bars. The Fed can print dollars, but it cannot print silver. That is the fatal flaw. Now let's talk about the physical heart of the storm, Shanghai. Yesterday we told you about 41 tons withdrawn. Today, another 43 tons. That's 84 metric tons in 48 hours. Let's translate that. 2.7 million ounces. Gone. Removed from registered inventory. Normal daily withdrawals, 2 to 3 tons. Today, 42 tons per day. That's a 1,400% increase. This is not industrial usage. This is panic hoarding. 2 days ago, inventory was 755 tons. Today, 727 tons. They are draining 3.5% per day. At this rate, the exchange has been empty for weeks, but it won't go linear. It will snap. Below 500 tons, the run goes exponential. This is strategic capture. The state, battery giants, solar manufacturers, they're securing atoms before borders lock. Every ounce leaving Shanghai is gone forever. It cannot return to New York, and the Western banks know it. Now the panic spreads, from vaults to boardrooms. We've entered the industrial phase. Samsung has reportedly secured 6 months of silver supply. Normally they hold for 2 weeks. Overnight they removed half a year of demand from the market. Why? Because phones without silver don't exist. Tesla internal memos label inventory as critical. Buyers are authorized to pay above spot for immediate delivery. That is the smoking gun. When Tesla ignores spot price is dead. Chinese solar giants are doing the same. TOPCon panels use 50% more silver. China controls 80% of solar production, and now they control the silver. Try buying silver at $72. You can't. US Silver Eagles? $12 premium. $84 is the real price. Canadian maples? $10 premium. Generic rounds? $8 premium. That's an 800% increase. Dealers know they can't replace inventory. Wholesalers are freezing sales. Pre-order delays. 6 weeks. That means empty refiners, gridlocked supply, retail, industrial, and state, all aligned. Silver is $84. COMEX is the only one pretending otherwise. Now we stop looking backward. We look forward. The most dangerous 36 hours in silver history. Final liquidity, final chance to cover. Expect volatility, smash attempts, fake rallies. It doesn't matter. Once the bell rings, doors lock, the train leaves, markets closed, screens dark. But panic explodes behind the scenes. Risk managers are awake all night. Industrial CEOs make calls. Off-market bids explode. Prices you'll never see on charts. China's export ban is active. Borders sealed. Arbitrage is impossible. I expect a historic gap up. $72 cannot open. Algorithms will chase reality. $78. 80 SARS. $82. But price isn't the danger. Force majeure is. Dealers default. Cash settlements offered. Lawsuits begin. Premiums explode to $15. $20. Spot price becomes a museum exhibit. For 40 years, paper suppressed reality. In the next 36 hours, gravity wins. China removed the physical buffer. The Fed exhausted the liquidity buffer. Industry exhausted the inventory buffer. No buffers left, only truth. Do not fear red candles. Pity those trading real assets for printed promises. You hold what Samsung needs, what Tesla needs, what China is hoarding. The era of paper silver ends tonight. The era of strategic silver begins Friday. This is Financial Secrets from Financial Secrets. The warning is delivered. The timeline is set. I'll see you on the other side of the gap. Like, subscribe, share.